Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch, and in today's podcast, I'm speaking with Dan Winter and Rowan Grant, the founders and portfolio managers at Arbor Capital. Arbor Capital is an investment firm focused on venture capital and growth equity investing within the SaaS and tech sector. They work with family offices and high net wealth individuals who are seeking to invest long-term patient capital in high growth private businesses. Dan and Rowan share their journeys from entrepreneurs to family offices and to the establishment of the first fund in 2016, which at the time of recording has achieved a gross investment rate of return of above 30% and multiple on deployed capital of more than 4x. For me, I enjoyed hearing how their journey has led to the evolution and their launch of their new fund, how it's shaped their new structure, their investment philosophy, and what they're looking for when investing and targeting private growth businesses. If you're about to take off for the Australia Day long weekend, or you're enjoying a couple more weeks of fun in the sun, I hope you've had a great, refreshing break and you're looking forward to pursuing a prosperous new year with the team here at the Rate of Change. With that being said, I hope you've enjoyed this conversation as much as I did, so sit back, relax, and enjoy it. Dan Winter and Rowan Grant, welcome to the Rate of Change with York Wealth Management.
Thanks for having us, Murdoch.
Hey, Murdoch, good to be here.
Why don't we kick things off by telling us a little bit about yourselves and how you both got into financial markets. Dan, why don't you start things off?
Sure. Maybe I'll give you a bit of my background. So I guess I studied international relations business at Bond University on the Gold Coast. And during my time studying, I guess I realized pretty quickly that I had a passion for technology and technology businesses. So I actually teamed up with a friend of mine and we started to build our own technology software. And it was a really interesting experience, taught me a lot about tech and business, and ultimately decided not to continue on with that venture and actually went off to pursue management consulting to try and broaden my perspective and learn a bit more about big business and sort of how technology, strategy, finance all came together. So quickly after graduating university, I went and became management consultant for a firm called Accenture. I guess technically I was in technology and strategy consulting, and did that for a few years where I learned exactly what I sort of had intended to get out of that, a lot about how big business operates, ASX listed companies and so on. And toward the sort of end of a couple of years there, I went back to the drawing board and I thought, what is the rest of my career? And for me, it felt like the right thing to do was to look at investing in technology, either becoming a founder again or to make a move into investment. So basically, at the end of that journey, I joined a family office and worked in a small family office that was doing pre-seed and seed stage technology investing. At the same time, met Rowan and we actually started our first fund together. So perhaps I'll pass to Rowan. He can tell you a bit about that and his background.
Thanks, Dan. Murdoch, I'm a recovering chartered accountant for my sins. Started life in business advisory and taxation. Didn't like it much. It was good, like fundamental knowledge base to have, and reading and understanding financial statements, but couldn't see myself becoming a partner of the firm. Did a complete 180 and started a tech startup in the music space, like a consumer-facing startup with like no idea and no skills on how to do that, but learnt a lot. And that was sort of my entree to the tech space. And around the same time, was getting mentored by CFO of a family office. And after that startup failed, joined that office. And that was sort of my then entree into private market investing. Stayed there for a while, really, really enjoyed it. And then had this really hard decision on whether to stick around and keep learning and expanding my network, or go back down the entrepreneurial path and start a fund. And met Dan Winter at around that time and decided couldn't sort of put out the fire of that internal sort of optimism of an entrepreneur, and decided to leave the family office and start a venture fund.
Yeah, it's pretty interesting the journey we all have to get to where we are today. It's not exactly a straight line, is it?
No, it
Definitely
never
not.
is. It always
Not.
sounds like a smooth narrative, but it never is.
Yeah,
The reason why I
not in
find
the
that so interesting, you're saying,
Sorry,
Dan?
Murdoch. Yeah, I was going to say definitely not in the case of myself. I thought I was going to end up working in the United Nations at one point, and couldn't
The
have ended.
United Nations. I
Yeah,
know this is a
that was the
podcast about
goal.
managed
Couldn't have
funds and
ended further from
investing, but I
that.
need to know the story. United Nations in what sense?
No. It was more an ambition, perhaps a far-fetched ambition. But at university, that was my interest. So I wanted to work in politics or international affairs in some capacity, and pretty quickly realized that wasn't where I was going to land when my technology interest creeped in. So couldn't be further from it now.
Don't worry, we all did it. At university, I wanted to become an architect. I was actually in the architecture faculty. You should have met half my mates. They were the Da Vinci's, the Michelangelos, and I realized pretty quick, smart, that I needed my cab license because I was nowhere near as good. But yeah, how interesting. The other thing which we were discussing as well is what you guys do essentially, to my understanding, is you service the clientele which you service are high-end family offices. And do you guys want to talk a bit about, as you said, with your upbringing, you guys have actually worked for family offices. So would you say that mentoring, working within these communities has given you essentially the understanding of what wealthy families look for in particular investments? Is that, and then essentially the managed fund is the vehicle about trying to put the two together? Like, do you want to talk a bit about that? Is that correct, or have I got that completely wrong?
No, I think you've done a good job of summarizing that, actually. So both Ron and I come from family office background in some capacity. Perhaps I'll talk a little bit about my experience there, and then Ron, you can talk about yours as well, because despite having a lot of overlap in our careers, we've got very different experiences in terms of family office exposure. But it was, for me, it was very eye-opening, because I joined a family office that was looking at the earliest stage investing. So we're talking like napkin stage, concept ideation stage companies, where you're dealing with founders that have ideas and nothing else. And it's a very uncertain environment. Teaches you a lot about picking founders and what to look for in people, I guess, more so than opportunities, but also how important it is to have well thought out business ideas that are backed up by sustainable business models. So I guess that part of the family office world, my early stage exposure, is sort of partially what led Rowan and I to building Arbor Capital, which is where we are today. But then, in addition to your point, like understanding how to manage money, learning sort of what's important from a LP standpoint and limited partner standpoint, the backer of the fund, is very crucial to really getting a good grasp of what to think about when you're deploying capital, the types of risks, the potential for returns, and how you're going to generate liquidity and so on. So in my experience, it was super, relevant, and contributed largely to where I've landed today.
Yeah, I think it was a natural progression for us to target family offices as LPs, given we had worked previously in investing teams at family offices. I think family offices are like eclectic beasts. I think it probably doesn't look this way at the outside, but they're highly emotional organizations when you think about it. I was very surprised to understand and see firsthand, despite a solid investment strategy and process written down, how often decisions or investments would be made based on emotion. And understanding that, and that's natural, that's life. It's not necessarily a good or a bad thing, but having that insight and seeing asset allocation exercises at a family office, and then all the way through to the deployment and security selection operations, I think it gave us a good insight to talk the same language and to, when we're crafting our investment strategy, position that well for family offices. So it was sort of a natural progression based on what we'd seen in our prior roles.
So that progression led to Arbor Capital. So you have two funds, right? You got the original, and then you got the new fund. So why don't we, for our listeners, segment that a bit? Why don't we discuss the first fund? You know, how the family office style learning. You know, you figured out what you're looking for, and then you use that particular vehicle to invest. You know how the returns have been. Do you want to give it an overview of that first fund, and then we'll second to the second?
Sure. So the first fund was a typical closed-end limited partnership focused on early stage technology investing. So seed and Series A primarily, had a very specific mandate, and it was fundamentally an extension of what Dan and I had been doing the previous, few years at the family office. So it was a very defined mandate. We would look at B2B, software as a service, marketplace style business models across a sort of generalist approach from an industry perspective. And that fund is, what was that, 2015 vintage, I believe. So it's coming up on 7 or 8 years now. It's a 10-year fund, so it's hitting the tail end. We've just started to have exits come through in the last few years. I think our IRR, we've just had a couple of markdowns in this environment, so it's dropped from, I think, what was 44% to around 30, low 30s. MOIC is 5.7 from memory. It's a highly concentrated, high conviction fund. We typically took board seats and was as involved as we could be with the companies given time constraints.
What were the returns? What's been the returns for that fund?
Yeah, so MOIC was 5.7. IRR is sitting low 30s at the minute.
And how's the alignment and the fees work?
We took a pretty standard approach to fees. We just did 2 and 20. We didn't want to. Well, we were pretty new, right? So Dan and I were both in our 20s when we started that fund, which I think, in some respects, was too young. But we were risk takers. We were lucky to have experienced private market investing at family offices. So there's a lot we didn't know. But in some sense, glad that we did that early, because we've still got a good chunk of our careers left and we've learned so much. So we're sort of rolling that learning into this current fund as well.
So the businesses which you which you invested in with that original fund, what was the criteria? Like, what were you looking for?
Do you want to take that, Dan?
Yeah, I'll take that one. So back then we had a very specific mandate for early stage, SaaS technology businesses. So quite a constrained mandate from the sense of not deploying broadly across categories, but looking heavily at companies that were at that expansion growth stage. So Series A and software-oriented business models. So pretty much every company that's in the portfolio that we had there is a software-based business model of some kind, and has exposure across many different industries. So I think we have one that's sort of fintech exposed. We had one that was AI exposed, one that was logistics, and one that was education. So as Ron said, very highly concentrated portfolio there with exposure to software business models.
And then, so these businesses, how did you find them?
Look, when initially, I think, given that Ron and I both came from the family office backing, we had fairly strong access to deal flow from many channels. So you kind of, when you're working in the industry for a while, you sort of build up a natural direct inbound of founders that are looking to just have conversations with venture investors who have been around the industry for a while, who actually have seen many different opportunities. So we had a large amount of just cold inbound come to us personally. And I think second to that, like, the typical ways of getting out and meeting founders at events and promoting the brand through content pieces would always generate additional opportunities as well. Probably the most common strategy, I guess, for founders to reach out, at least in terms of some of the higher quality opportunities that we would have come across the desk, were related to founder introductions. So these are founders that we'd already invested in or worked with in the past, where they'd speak about us as their investor to other founders in the ecosystem, and those founders would then make the introduction and be like, "Hey, Dan, Rowan, do you want to chat to this particular company?" That's always been a really strong source of deal flow.
So interesting. And the other thing, which we discussed many times before, is when you were doing deals, some of these transactions you would take actually quite a large percentage of the business, right? So, and we discussed it with these quite like working with these founders led businesses. So, how much equity stake would you look to take in these businesses, and how would you go about helping improve those businesses? To your benefit and their benefit.
When we were doing our portfolio construction for the first fund, we had a target of around 10% ownership. Now that varied quite a lot, and it depends on entry stage too. So we did a few pre-seed investments where we owned 20 or 25% of the business, and then in some Series A investments we were owning 5%. So your entry point can dictate that a lot. But I mean, we won't go too deep into it because it's a big topic, but the venture returns and the power law dynamic, and then, how big your portfolio is sort of dictates if you're going to have any given opportunity have the potential to return the fund. You need to own, a decent chunk of that. So the theory goes. So we didn't have any hard and fast limits, but I'd say around the end of the day, it was around a 10% ownership.
And the reason why I was asking that is, we've seen in the past couple of years that this particular space take off. But if I'm understanding correctly, the majority of the investments you made were essentially before, that bell curve went incredibly north. So was that luck that you managed to set your feet at the right time, or were you looking at valuations and the deals were attractive at that particular time, and then when they go higher, you're just like, oh, we just don't want to touch this, or what was your mindset?
Good question. It's a bit of both. Dan and I've been talking a lot about how a venture fund is started really based on the timing of the principal's career, right? As opposed to where you are in a market cycle. And I think probably for better or for worse, and probably, to be honest, for worse, the LPs in funds are exposed to venture funds separate to the market cycle. And not saying that you can predict that, but like we were, mid to late 20s, and venture was just sort of, coming out of GFC, pretty quiet in Australia. And we started at a fortuitous time when we just had then six years of just up and to the right in valuations. So that made us feel all very smart and special. But if we're honest, there's a good chunk of luck in that. On the analysis and decision-making side, we are very price conscious around valuations. So that means in the last 3 years, we sat on our hands a good chunk of the time. We couldn't make sense of a lot of the valuations based on company growth rates and how big we thought any given opportunity could be, and comparing that to the valuation being proposed, we just couldn't see how we would hit our target IRR, which is 25%. And so we do a lot of rigorous modeling and analysis around that. And it meant that every time we were doing our valuation analysis, not every time, but like a good chunk of the time, we would either just bow out and say, guys, we don't believe we can make the returns given this price, or we would submit a term sheet based on the price that we were comfortable with, and we would get outbid by a large margin. And I mean, like in many instances, up to 300%. there would be a fintech opportunity that we'd put at a 10 mil pre-money at the seed stage, and someone would come and pay 30. And that shakes you a bit, because you start to go, well, are we missing something?
Okay,
Like, is
silly question, but I have to ask. Like, did you ever look back at those cases when that occurred and go, is this company still alive?
That's a very good question. Rowan and I speak about this all the time. We because, to Rowan's point, sometimes we'd issue a term sheet and we'd be like, why have the founders gone quiet? Something's happening in the background here. We can't quite figure out what's going on. And then all of a sudden they'd come back and they'd be like, look, like we're actually accepting this term sheet that's 3 times higher valuation than what you guys have proposed. And we'd sit back and we'd just be like, this is ridiculous. I can't believe someone's willing to pay that amount. And it's interesting to your question, Murdoch, because on reflection, we actually do keep a strong relationship with all of the founders that we get to term sheet stage. And we often have looped back and tried to, reconnect and explore opportunities to see if there's another opportunity to invest, because presumably the companies have grown and become stronger, better companies, and the market fundamentals have shifted in a way now where perhaps those valuations are more realistic. So actually early in the year, we started to do some of those reach outs to learn a bit about how wrong we were, or if we were correct. And, we had some interesting findings. Like, some of those businesses were raising at flat rounds, despite being 2 or 3 times larger than what they were when we were looking at them initially. So heaps of valuation multiple compression happened between, I guess, when we were outbid and when we'd revisited those opportunities. So it is fascinating. But I think Rowan mentioned it earlier. I think the cycle of venture can be, I guess, a good thing working in the favor of everyone, or it can be a bad thing. And I think at that particular point in time, three or 4 years ago, valuations were just out of control. So there was so much room for correction and multiple contraction, which I think has definitely started to unfold now. At least what we've seen in the market is that valuations are looking much more reasonable, and a lot of these companies are actually still alive and succeeding. However, the valuations now look a lot better.
Yeah, it's I always get told, don't use television shows when you're talking finance, but I always love that show, the Silicon Valley, right? Hilarious. And there was a
Great show.
particular scene at a party when the guy's throwing a massive party, and it's like, what's this for? We've raised $500 million with this, that, and the other. And then 2 years later, he sees the guy in a bar, and he's just like, mate, what are you doing here? It's like 11 o'clock on a Monday. And the guy turns to him and he goes, I'll give you one bit of advice. No one ever said, you could take less money.
Yeah.
And everyone just looks at each other and just goes, wait, you can take less? He goes, yeah, no one ever said you could take less. Because what happens is the more you take, the more expectations grow, the more you have to grow, the faster you have to grow. And it's fine if you hit the first hurdle, everyone's happy, but, then it's a bigger hurdle. So, mate, and then he's practically hammered. He's like, best advice I can give you since you're doing a deal, you can take less, take less. I thought that was the best bit of television advice I've ever heard. But no one ever discusses that. It's because everyone gets paid from doing all the deals and it all gets exciting.
Yeah, well, it's funny.
I digress.
But no, good digression. Big best series of best tech oriented series of all time. I think that's
so good.
Legendary. But it's a good point that you make, because it's actually, I mean, some of the shifts that we've seen in the market over the last 12 months are really positive in that sense. Starting to see founders think a lot more about, how do we do more with the money that we have or that we're going to raise. They're a lot more conservative with their projections and with their thinking around capital injection coming into the company. So that's had, I think there's very positive flow-on effects from a lot of the macro environment, complexities that we've had over the last 12 to 24 months. And it's really forcing founders and investors to go back to the table and rethink some of these growth models and some of these business models. And, how do you actually sustain a business long term? How do you make a business that doesn't need to raise capital? It's good to see that conversation coming back into the picture. And definitely something that Rowan and I have thought about a lot with the new fund is looking at those opportunities to sort of ride the wave of that corrected logic in the market, which is good.
Well, this is a great segue after everything into the second fund, right? We've learned, we've made money, we've prospered, things have gone wrong. So I would love to hear what is the new fund? Why is it being started now? I think we're discussing as well. There's what, three different tiers
Yeah,
of investments. You look at all the
yeah.
thinking of the investments. So if you want to give everyone, maybe let's begin with how's it structured? Why is it structured that way? What are you looking for? And then how you tier the investments.
Maybe I'll do the high level and pass to Rowan. I think this one will have to split because there's a lot to unpack here. So, at a very high level, Arbor Capital, our new fund, is an investment firm that's focused on venture capital and growth equity investing in technology companies globally. I guess the tagline for the fund, or the tagline that Rowan and I pitch when we talk about the fund to founders, is that we provide patient capital for high growth private technology companies. And there's a lot to unpack about how we got to that point, and I guess how we came to the foundations of the fund. But a lot of initially, a lot of our thinking stemmed from the fact that Rowan and I were both very passionate long term thinkers, and we wanted to align that personal mode of operations with, I guess, our strong conviction that patient capital being deployed into private technology opportunities could deliver superior returns long term. And so those concepts of, patience, long-term thinking, long-term investing, compounding capital, and private high-growth technology companies were sort of key to the foundations and establishment of Arbor Capital, which is the current fund that we're working on and raising. And I think there were so many learnings that we had from our first fund that led to some of the more technical elements of the development that perhaps Rowan can touch on, just around how we structured it, why we structured it that way, and how we landed on the strategy that we have today.
Yeah, so those principles of like long-term thinking and patience manifested into two material changes to, I guess, the investment strategy and the structure, comparing the last fund to this one. On the investment strategy side, it meant that we broadened our scope a little bit to not just pure play venture opportunities, but private companies that were still high growth, but they weren't on that venture trajectory of orders of magnitude, like multiple returns, and that a company that could be 20 or 30% CAGR growth that might be bootstrapped is still an attractive opportunity, but falls outside the mandate of a lot of those traditional funds. And we were seeing a lot of these opportunities and were restricted in our prior mandate from taking a look at them. So they'd come across the table. Dan and I'd be like, fuck, this is an interesting business. Wish we could dig deeper and take a look, but it's just not in the mandate. So we'd take a pass. And we'd always spoken like one day we'd love to be able to include these types of bootstrapped and non-venture scale businesses in our strategy. So this fund was an opportunity to do that. So we now look at businesses that have been bootstrapped. We now look at secondary transactions, whether that's allowing founders to de-risk their personal lives and take some money off the table, or buying off other existing investors, and sort of everything between that spectrum. So we've broadened that scope. It's still high growth private technology companies, but not just seed, Series A, venture scale opportunities. So that's the investment strategy and how it's different. The other quite meaningful change was to the fund structure itself. We did a lot of reflection and deep thinking around why funds tend to be these 10-year life closed-end vehicles. What's driving that fund life? Some are 7, some are 10 plus 2, these closed-end structures. And Dan and I had a series of conversations with probably older, more experienced investors around liquidity and time horizons and things like that. And a principle that we'd taken away was that having an arbitrary end life to your fund may not marry up with the natural exit point of any given company in your portfolio. And I think there's some funds in market today that have 2012 vintage that are probably coming to wind up stage now. And I know some of their portfolio companies aren't ready to either list or trade sale, and they're having to have conversations with their LPs about extending the fund or doing secondary transactions. And we just thought we would prefer to hold a position in our fund until it's the right time to sell. That could be 3 years. It could be, to be extreme, 30. If you hold a successful company that's compounding capital at high rates, we would like to hold that company until it's the right time to sell. So we ended up shifting away from closed-end fund structure to effectively an evergreen or a permanent capital structure where we can open the books periodically to take more capital in. That's also probably a topic for another day, but provides us the ability to give liquidity to our investors periodically. But probably most importantly, it allows us to make the decision of when to liquidate a position at the right time for us and the company, not when the fund, ends in 2 years' time, for example.
Yeah, that's quite frustrating and challenging. Because as you said, the first fund, it's 7 years in, you literally have 3 years, and then what's going to happen to the businesses? Or can you potentially structure it in a way if those businesses are going quite well, your second fund can essentially acquire the interest in the other fund, or does everything kind of have to be dispersed?
Yeah, there's a few things that happen at the end of a fund life. One is that you baked in your LPA, your limited partner agreement, you have an option to extend. So 10 plus 2 plus 2 is reasonably common. You can sell your position on the secondary market. You can roll it into another fund. Yeah, there's a plethora of options. But I think what didn't make sense to us was just having this arbitrary end date. Like maybe 10 years is a good amount, maybe it's not. But wouldn't you rather hold the company until the right
and
time?
unnecessary. It sounds like the people that are making money out of that are the lawyers and the accountants.
Yeah.
True.
We very much just thought about it as like, the best time to exit a particular holding or a particular company will vary so much company to company, and it has no bearing or no relationship to how old our fund is, and also how much we need liquidity in some sense. Like the best time to exit a company will be when the best time to exit that particular company is, and no other factor should determine that. So when we were thinking about fund design, to Rowan's point, it was critical for us that we allowed the structure allowed for us to hold positions as long as we need to generate optimal returns. And I say to generate optimal returns because we might also realize that an asset is no longer going to grow at the rate that we need it to, and then that is the time to exit that specific position. So it's not necessarily that all assets would be held forever, but more that we'd do thorough analysis to work out when the right time was to exit a particular holding.
Well, it makes our lives a lot easier, especially when we're speaking with clients. One of the main topics with family offices and wealthy families these days is how do you transition wealth, the transfer, the intergenerational transfer. And then what you learn and you understand is that these founders, wouldn't you agree, these founders, they're the ones that have the vision, build something up, but it's a lot to take for the second generation or third generation to be forced into being, I don't know, a baker, candlesmith maker, when essentially, I know they're a musician, right? What do they know? But, in saying that as well, they shouldn't be robbed of potentially a great business that's generating a 30%, cash flow every single year because it's a great product. Yes, they don't want to have a bar of it, but, that cash flow is quite important and, it's doing the right thing. So,
Absolutely.
And here's a question. Do you think potentially the closed-ended funds is a main reason why there's such a push for transactions in these businesses? Or do you think if the main structure was like similar to the structure which you're setting up for the second fund, there wouldn't be this need to look for exits as much? Like, I'm just thinking behavioral psychology. And the reason why I'm going with this is kind of like when the American system kicked things off, as in they'll go in and you get a 3-year contract, gut the contract, gut the company, hit all their incentive schemes, get paid, but they just cannibalize the entire next 3-5 years in order to achieve everything today. And then, it looks great on the stocks right now, but then the next 10 years, the life of that company is horrendous. Do you think there's a changing culture now?
I don't know. It's a good question. Like, I know there's a few funds that have breakout companies like Canva in there at the moment. And I think from what I understand, those LPs have been happy to extend the fund lives because, there will be there's been a lot of paper value creation on Canva, and that will materialize into liquidity at some point. So I think if you're sitting there as an LP in one of those funds that holds Canva, you're probably happy to wait. On the flip side, if you've got a company that's not performing so well, there's value there, but the line of sight to liquidity is less clear. You might be sitting there going, well, what are we holding on for? Like, are we actually, is our capital tied up here to produce more returns, or is it tied up here on a hope that things will get better? So yeah, it's a good question. I'm not sure. I do know from memory, the average life cycle of day zero to IPO of a company is 10 years in Australia, I think. So maybe it's something to do with, on average, liquidity should happen in 10 years in a company. And maybe that's where the sort of 10-year fund life came from, but I'm not sure.
Well, we'll dig into that, another day. But let's get to the fun stuff. What opportunities are you seeing in the market? And why I'm really interested in this, God, it's been a roller coaster. Free money being poured in on the macro, during COVID times. Then they go, uh-oh, it's too much. Let's pour water over this fire, starve everyone. Everyone's pivoting. And then we're in this interesting time where, I don't know, the conversations we're having is there's a lot of companies out there that want money, need money. And it's potentially, hypothetically, a great time to invest. But a lot of families, they're a bit gun shy. It's probably the nicest way to do it. And not necessarily gun shy, they're looking at other alternative assets such as, commercial property, private lending's paying 15%. So it's more, risk reward. Right. So, how are you finding the sentiment out there for the asset class, which you guys currently cover? And what opportunities are you currently seeing?
I think there's probably two questions in there in one. So the first one is like sentiment, I guess, from the families and the LPs behind each of the funds that are being raised at the moment. And then the second one is like, what are the actual opportunities that we're seeing in the market to deploy capital? And I think maybe I'll touch on the second one, and Rowan, you could touch a little bit on the first part of that, so on the LPs. But in terms of the technology opportunities, I think we're seeing a range of different things come through now. We're starting to see companies that are falling out of the scope of VC because they've been backed by VC dollars in the past. However, they're not high enough growth rates anymore to sustain VC reinvestment. So there's a lot of those type companies coming through that are like, well, actually, if we're not going to be on that 100x journey anymore, what do we do? How do we raise money? How do we actually flip this business, make it sustainable, make it more interesting to a wider range of investors, or actually turn it to profitability? Starting to see a lot of founders have those sorts of discussions with their investor base and also within their boards, which is interesting and generating a whole new type of deal flow and opportunity. I think we're seeing a lot more founders in the early stage actually start to think about, how do I build a business that doesn't require funding? Or is there a way to reduce or limit the amount of funding that I need over the overall journey, so that I don't find myself having to raise enormous amounts of capital and have huge preferential stacks above all the ordinary shareholders, which is also a theme that's been talked about a lot at the moment. How the just for those that aren't across it, that's how the preference stack of capital impacts the ordinary shareholders, and most often the ordinary shareholders will be the employees and founders of the businesses themselves. There's a lot of, I guess, talk around some of those concepts. And then more broadly, I think we're seeing a lot of just well-priced, great founders building good businesses that are just coming through looking for great strategic partners long-term. So I think that's been an exciting trend as well. In terms of the LPs, maybe Rowan, you can cover, I guess, the appetite side of things, like with the capital flowing into venture funds.
Yeah, so I'd say in the last year, so we've had a lot of conversations with both existing and prospective LPs, predominantly family offices, over the last 12 months. And there's been probably since that Silicon Valley Bank, the regional banking crisis in the US, since that early March, there's been a lot of pullback in interest in private markets, we've found. and talking to our peers in the venture space, sort of that seems to be unanimous, and that sort of coincides with the inflation and the rate rises, right? So as the interest rates go up, pushes up the discount rate, lowers valuation. So I think there was a dynamic of people not wanting to catch a falling knife and do new deals, knowing that they could be buying something that's value is lower in any subsequent month after that for a period of time. So most investors we spoke to were sitting on their hands. They were having to allocate any liquid capital they have into re-upping either the main family business where the initial wealth came from, if that's still an operating business, or re-upping into existing funds that were having to then re-up into their portfolio. So there was a lot of holding cash for those types of scenarios, which is funny because we spoke earlier in the conversation about how uncomfortable we were with valuations for the prior 3 years. Around that exact same time, like the start of 2022 calendar year, we got really excited about valuations for the first time in a long time, and we were eager to deploy. And it's one of those sort of fearful when others are greedy situations where we were seeing the best deals of many years, and no one was there doing them. So I found that very interesting. But I think of recent, like the last couple of months, I think people are starting to be a bit more confident again. We're seeing deals get done. Valuations are still modest and attractive in our opinion. But yeah, it's still, the pace is so much slower than the prior 3 years.
Yeah, look, I was speaking with someone else that pointed out to me that Christmas rally, which we saw like beginning October, November, the Russell 2000, literally in a month or 5 weeks, went from its 52-week low to its 52-week high.
Wow.
That's crazy.
Right, after doing nothing, like practically before. And then the other thing which was quite interesting, which we saw, like, just doing a check over what happened last year, is if we completely disregarded what interest rates did and we literally made our investment decisions, I'm talking about macroeconomics here, based on the Australian 10-year bond rate and the US 10-year bond rate, you pretty much would have called the market. That I find incredibly interesting about things, how things have behaved. So that's why it's very interesting to hear what you guys are seeing as opportunity currently. And then what do you think is going to happen 2024?
Pretty excited about 2024, to be honest. It's I think it's a lot of people are thinking about the market as sort of like a fresh slate, see what happens, see what happens with the interest rate rises if they come through, how that impact will flow on. But if we're talking specifically around startups and technology companies and building business, I think, as I mentioned earlier, there's been like this return to a lot of fundamental thinking, and that's a really good theme for us as investors, and I guess anyone as an investor right now looking at private market opportunities, because it's just forcing the discipline back into the industry that perhaps was lost a lot over the prior 10 years, or prior 5 years, I should say, when there was just an abundance of capital available in the market just flowing into these technology companies. That created a lot of unstructured thinking, a lot of a lack of discipline, and the flow-on effects of those things are huge. And seeing that correct, I think, has been a very good experience, and I'm quite optimistic about the opportunities that we're seeing come across the desk already across all the categories. AI being a big one, we're seeing a lot of that at the moment. So I think, there's no shortage of entrepreneurial talent and technology companies coming through. It's more so trying to find some stability and clarity through a lot of the macro uncertainty and how that unfolds.
Yeah, Dan, so you mentioned AI. It wouldn't be a conversation in this century if we didn't discuss AI. So with the deals that you're currently seeing, what's interesting that you're seeing that's come across the table? Are they companies that are a legacy that AI has been introduced to kind of make them become attractive? Or are these legitimate problems being solved by artificial intelligence as a tool to essentially, improve a service industry or solve a problem?
It's a good question, Murdoch. we are seeing a lot of, I think Ron and I sit back and talk about this all the time because there's a lot of noise in the AI space at the moment. I think it's something that investors have to be very careful about. I mean, we have had many discussions where we think a lot of the AI opportunities that are out there in the market at the moment are actually uninvestable or not interesting. And there's a couple of reasons for this. You touched on a few of them, but I think there's a lot of businesses out there that are sort of positioning themselves as AI enabled or AI equipped that are actually just to your to earlier thoughts in the podcast that we've been speaking about, like they might be services businesses, or they might be software businesses that are non AI, that are bolting on AI functionality. They may be early stage companies that are positioning themselves as AI, but there's actually no AI talent in the team. They don't actually have in-house AI. They're just leveraging third-party apps. So you have to be very disciplined, I guess, and specific, and do your diligence on most of the AI that's coming through at the moment to actually validate that, one, it is what it claims to be in terms of there is AI there. Two, that there's actually people in these companies that understand what the AI is doing and how it's working, and how to create value from that AI. And three, that there's actually a sufficient, or should I say, viable business model behind the AI component of the business that should be monetized or could be monetized. So these are some of the discussions that Rowan and I have when something comes across the desk. The first thing we'll look at is what's actually here in this business that's AI, and who is building it. And if you start to do that level of analysis, I think you learn pretty quickly that there is a lot of noise, there's a lot of garbage, and you do have to be very careful with what you're investing in. And to be frank, there's very few businesses out there that have actually proven a viable business model where the economics are sustainable and make sense. So at least from what I've seen. So I think it's there's a lot of AI opportunity, a lot of technical interest and entrepreneurial interest going into the category, but definitely something to be very careful of. I'm not sure if you had anything to add to that, Ron.
No, I agree. I'm sort of an optimist as a consumer in the AI space, but from an investment side of things, a lot more cautious. And you can see it in our deal flow data, just the spike in number of companies that are using AI in their pitch deck, because we track our deal flow, and we'll tag like the software type, the industry, things like that. And I don't know if it's half, but it's spiked dramatically, the number of companies coming in saying they are in some way related, or building AI has just gone through the roof. And it's just not true, because we don't have that much genuine AI talent. So I think there's a lot of noise, and that makes us nervous. So we typically sit back, do a lot of reading, thinking, let others move first when something is moving this quickly, because frankly, I think it's going to be a lot of mistakes. And whilst we like risk, we don't like making a lot of mistakes. So I'll keep playing with DALL-E and ChatGPT on my own time, but I doubt we'll be doing.
Well, the reason why I like using fund managers is, let's be honest, you guys are substantially more intelligent than I would ever be in a particular topic. I'm just a jack of all trades, knowledgeable at everything, but not as much as anything. But what seems to have me dialed in is the social media, platforms. What I want. Clearly, I must have been talking about contracts to somebody, or like accidentally maybe just thinking it, and they've tapped my thoughts. But there's this, I can't remember the app that came up, and how they pitched it was, it's an app created by AI, which is essentially like the ChatGPT for legal negotiating contracts. Give us a contract, say specifically exactly what you want, and we'll negotiate as hard or as little as possible particular things and give you options. I was just so excited until I found out, please put your information in here, and we'll send you an update, when it's actually about to work. And I'm like, well, that's great. I kind of need it today. So that, to me, we're seeing AI, software as a service businesses. There is services like that business owners like myself, that is a viable business. That there is incredibly helpful. It can get me a running jump on something. And then just like when you get sick, you Dr. Google it. Doesn't mean I'm right, but at least it gives me the ability to play with something that I couldn't potentially play before, and then take, a couple of versions, go what I think, and then take that to a professional who has trained for 400 hours, 1,400 years, whatever it is, to get the advice that's appropriate. Wouldn't you agree that there is a viable something that sounds interesting? Is there anything like that? Fine. Is that actually a real business? It's probably just some dodgy marketing thing on Instagram. But like, have you seen any businesses like in the legal practices that would be quite attractive in that particular area?
Not in the AI space. I know some stuff exists. I may have seen the same thing as you, the negotiating, the chat GPT for negotiating. I didn't try it though. I'm always wary of like uploading our legal documents into stuff like that until I know like who the company is and what's behind them, because they're capturing that data. No one reads the T's and C's. Like, what do they do with that? So I've seen them around. I know the potential for disruption in the legal industry space from AI is huge, right? Which is worrying a lot of the younger lawyers that I talk to. But haven't seen any in the flesh.
Interesting. I didn't even think about that. Obviously, the copyright makes a lot of sense, but but anything that's just high service, what we're seeing in financial planning as well. Anything that's high amount of legal work that can essentially take an 8-hour task and turn it into 2 hours and spit out something that's highly accurate is a great result.
I think you're making a good point, Murdoch. Like there are a lot of different use cases where, as a consumer or business, using the AI service is valuable. I think that there's absolutely no doubt about that. From an investor standpoint, I guess the conversation that Rowan and I often have or always have is more on the back end of that. Like who's actually providing the technology that provides the value, and how is that monetized, and is that what we're investing in, versus as a consumer, do you get benefit from using this platform? And those two things are, while they seem similar, I guess the difference comes down to who's building the technology and who's getting the economic value of having deployed it to the market, and do they have the right licensing and the right rights to actually be able to monetize that particular technology and then own the IP behind it as well. So it's those kind of questions that we find ourselves asking. There's absolutely no shortage of really funky tools on the internet now that are powered by AI that actually have very decent use cases, and they can be quite helpful for, to your point, making things more efficient or even accessible. So I think like you're absolutely right. There's some really cool stuff out there. But in terms of what we're thinking and what we're doing, we're just keeping a keen eye out there, and I guess analyzing everything that comes across the desk to try and really understand economic value and business models.
Well, thanks, Dan. AI is always quite interesting, but back to the fund itself. If anyone wants to learn more about the second fund, what's the best way they can find information, or is there anything that we haven't discussed that you think they might need to know?
Look, I think the best way to reach out to us is probably on LinkedIn. You can reach out to Rowan and I directly. I'm always pretty active on LinkedIn to make sure that I get back to any of the people that reach out. In terms of learning more about our fund and what we're working on, and I guess our philosophy, we have a website that you can access at arborcapital.co that talks a little bit about the philosophy. And in terms of what we're working on at the moment, we are still raising that fund. It is permanent in nature, so annually we do open the books and would love to speak to investors and family offices that really share our philosophy and would be interested in having a further conversation.
Last question I like finishing on is what keeps you up at night and what gets you out of bed in the morning?
Oh, geez, that's you've got me completely unprepared for that one. I've got no idea. What keeps me up at night? I think at the minute, Rowan and I have been on a journey of building our business over the last 2 years, and it's been a tough economic environment, and just generally a very tough environment to have discussions about venture capital and raising funds. So I think that's always been challenging, but a challenge worth overcoming and pursuing. So we're pushing forward and doing the best we can in the current environment. And maybe I'll pass to you, Rowan.
Yeah, I think managing other people's money always keeps you up at night. I agree. I think to some degree, I'd be worried if it didn't. And getting me up in the morning, probably literally and figuratively, my 3-year-old and 2-year-old get me up in the morning earlier than I would like, but it's worth it.
Well, gents, it's great to have you on, and really appreciate the insights you've given. I've learned a lot today. So, with that being said, I wish you the best, and I look forward to having you on again.
Awesome.
Thanks for
that was
having us,
fun, mate.
Murdoch.
Thank you.
Thank you.
Any views expressed in this recording do not represent the view of any other third party and are the sole personal opinions of the speaker. Any reference to financial product does not constitute advice or recommendation, and before any action, you should seek proper advice from your financial professional. Australian listeners should head to www.moneysmart.gov.au to find more information on obtaining financial advice. To get in touch with York, head to our website www.yorkwealth.com.au.